For more insight now into the latest Fed decision and how the markets reacted, let's bring in William Lee. He's chief economist at the Milken Institute. Always great to have you on, William. Thank you so much for being here. So first off, your reaction to the FOMC decision today. So no cuts in March, but 75 basis points on the table for this year. Markets obviously love the news. We just heard that Powell delivered, findings, and the S&P and Dow finding fresh highs.
The markets and everyone else breathed a sigh of relief because the Fed took the data in stride. The hotter than expected inflation and the stronger than expected economy in the terms of GDP and a lot of the employment numbers are still very strong. So despite that, I think the Fed is very convinced that we're on the right trajectory. The issue is the timing going to be right for 3 rate cuts? And they confirmed it. Yes, it is it's still on course for 3 rate cuts. So I think the overall position of the U.S. economy now is that it's doing very, very well. The risks on it, however, I think are ones where the labor market may start to crap out on us sooner than we think. And a lot of what people are worried that when the unemployment rate starts to tick up, it really starts to pick up speed once that happens. And so everyone's got their eyes peeled on what's happening in the labor market.
Not everybody wanted to see 3 rate cuts. We saw on the dot plot that some members were pushing for 2 cuts this year. How much pressure do you think the Fed is currently under to cut rates? Powell said the bank is still waiting for more confidence that inflation is heading in the right direction. But while revising GDP higher, unemployment a little bit lower, and core PCE a bit hotter, 2.6% up versus 2.4% at the end of the year. Are conditions restrictive enough right now? Does this Fed have a grip on inflation, William?
Karina, that's a great question. In fact, one of the secrets of the temple about the Fed, especially when I was working there, was how much is too much dissent. And right now, there's a lot of healthy discussions going on about why inflation seems to be so persistent. Do we have sufficient restraint on the economy? I think everyone would say unanimously, yes, we do. We have enough restraint. But how much longer do we need to continue the restraint? And that's where the debate is. And right now, the median voter is saying we can start to ease up this year and we can ease up by as much as 75 basis points. But you have a lot of divergences of views there. And as the data come in, if the data come in stronger, you're going to see the hawks start to take over.
William, how realistic is then their 2% goal? Because Powell reiterated that target again today, yet it sees only a 0.2% reduction in PCE by the end of the year. That's not a lot of disinflation.
It is stubbornly slow, and that's what's irritating. I think the Fed staff and all economists are looking at the data and asking, why is it that inflation is coming down so slowly? A lot of the blame goes to rental housing, the way rental housing is recorded. But I think it goes beyond that because the real concern at the FOMC table is what's happening with wages. Wages continue to be rising at a much faster pace than is sustainable for 2% inflation. And the real issue is the places where we see the accelerating prices are insurance costs, car maintenance costs, transportation costs, places where it's not so much the supply side, but it's the demand side. A lot of people need a lot of services, and there just aren't enough people with skills to provide those services, whether it's skilled doctors or skilled mechanics.
And then in your opinion, when do you think we actually see the first rate cut? And what would make them cut more aggressively? I know you touched on it just now. If labor softens significantly and perhaps, the housing issue as well has been incredibly problematic. The central bank keeps saying shelter costs will come down, but they haven't really done so.
Well, Karina, I've been saying fairly consistently that we will not see a rate cut until the middle of this year, whether it's June or September. That depends on the data. And if it really gets pushed down to the later part of the year, we may not be able to get the room to get 3 rate cuts. And I think the real issue is, why is it that inflation stays so high? If it's really in these core non-housing places, like, as I mentioned, like car repairs, medical services, then there's not much that the Fed can do except to continue to maintain that level of restraint until we see the inflation rate start to come down. And I don't think we're going to see 2% for another 2 years. So I think the Fed also is being very patient and saying we will continue to have the tightness that we need to keep inflation from rising again. The last thing you want is inflation to spook you and spike up again.
Yeah, well, we will wait and see how it all pans out. Thank you for that insight, William Lee.